So here I have a series of 5 questions for you guys to be able to answer. So we're going to start off with the very first one. If you have your Excel sheets available or your calculator, let's go ahead and compute these exercises right here. So this example number 1 says that you bought a bank bond worth $225,500, okay? And it has a simple interest rate of 7.45% and can be redeemable after 3 years, okay? How much interest will you be collecting at the end of 3 years? So in this case, my question to you here is, how much interest are you going to be collecting in 3 years? So once again, this is straightforward. All you have to do is go ahead and start computing those amounts right here. Okay? So in this case, right, my formula, which I've already have on top for you, okay? If I were to go ahead and calculate the interest for this, what is going to be my formula?
We multiply the principal times the rate times the time.
Okay? Times time, which is already in 3 years, right? So in this case, what's my total amount of interest that I'm going to be collecting for this particular bank bond?
$50,399.25.
Excellent. So then if that's the amount of interest that I'm collecting after 3 years, what is going to be my total future value?
$275,899.25.
Good, excellent, right? And 25 cents. Right? Excellent. So this is the easiest one, right? Simple interest, okay? So let's go ahead and do a little, I guess a little harder problems. So let's start here, right? I have this example here where I have a bunch of principles, a bunch of rates, and a bunch of time. Okay, so in this case, right, let's take a look at our first example here. If I have a principal of $15,000 at a 5.12% interest rate and it's redeemable in 5 years, right? What is my total interest I'm going to be collecting here? Oops, 5 years cannot be done. So $15,000 times 0.0512 times 5 years. So what's my interest here?
$3,840.
3,000
$840.
840. Okay, so I'm going to change this so it's reflecting dollar bill signs. Okay, so 3,000. Okay, good. So then what is going to be my future value? How much money is my whatever this is going to be in 5 years? What's my future value?
18,840.
Excellent. Okay. So let's go ahead and do the second one. Now in this case, right, I have my time frame as 90 days. Now in this case, right, if I'm supposed to do this in terms of years because my annual percentage is in years, right? Therefore, I need to convert my numbers here, right? Now, if you guys remember, if 30 days, okay, is equal to 1 month, okay, and if 12 months, okay, is equal to 1 year, let's do the calculation here. In this case, how many days is 90 days?
How many months, no?
Yeah, how many months is 90 days?
3.
3, right? 3 times 30 gives you 90. Now, let's talk about if it's 3 months, 3 months out of 12. Okay, let me type this in here. 90 days, okay, equals 3 months, okay? How many, so 3 months, okay? Divide that by 12 equals how many years? If you have to put it in terms of years, how much is 3 months out of 12 months?
It's 1/4 of the year, you know?
Yep, 0.25 years. Good. So in that case, this is how I need to calculate this one. My interest, right, is going to be my principal of $4,521.50 times my annual percentage of 0.0245 times, because I'm using 90 days, which is only equivalent to a quarter of the month of the year, I need to put it in terms of years. So in this case, I'm going to multiply it by only a quarter of the year. So how much interest would I collect if I only had this for 3 months? Anybody?
Be 276.277?
2.
No, or something like that, or 27. I make a mistake somewhere.
Okay.
27.
769.
Okay. All right. So then how much is your future value? Right? It's going to be $4,549.19 because you're just adding $27.69. Okay. So then here you go. Last scenario we have here, right, is going to be, in this case, 6 months, which is equivalent, okay, to half a year, right? So in this case, how much interest am I going to be collecting if I have a principal of $384,125.22 times the 0.0789%, multiply that by half a year. What is my interest going to be?
$15,153.74.
$15,100. Good. All right. So therefore, how much is my future value going to be?
$399,279.25, 26.
96.
Yeah, okay, 96.
Okay, perfect. Okay, excellent. So that's simple interest. Okay. So let's go ahead and do question number 3 here. This time, this time, this scenario says here that you were approved for a bank loan for $5,500. Okay, interest rate is 6.25%, and and it's compounded every month, so monthly. Okay, how much interest will be collected if you decided to pay it off in 5 years? Okay, so here we have the components here that we have a principal of $5,500. We have the interest rate of 6.25%, and we have the number of times compounded, which is 12, and the number of years, okay, is 5 years. Okay, so again, we can't solve for interest first because the interest is going to tell you that it's your future value minus your principal. So in this case, I need to solve for future value first. And this is how I'm going to do it, right? I have the little example up here, right? But this is how I'm going to do it in real time. So in order to activate your equation in Excel, you're always going to do an equal sign, right? First thing you're going to do is you're going to type in your P, or you can do cell referencing, which is what I'm going to do. So in this case, I'm going to pick up my P, okay, and I'm going to multiply it, okay, and then I'm going to add my first parentheses, 1 plus another parentheses, my R of 6.25%, right? I'm going to divide that whole entire thing by the number of times compounded, which is your 12. You're going to end your parentheses twice, okay? You're going to add a caret, which is the number 6 key. Then you're going to open up your bracket one more time, and you're going to do your number of times compounded times the time. Okay, and then you need to end your parentheses or else your formula will still not work. All right, so at the end of the day, how much is my future value if I follow through with this exact formula? So what is my future value?
I came up with 7,511.514462.
Good. Make sure you round that.
Okay.
Okay. Excellent. So therefore, what is going to be my actual interest that I collect? Right? The interest is going to be your future value minus your principal.
2011.51.
Good. 2011 and 51 cents is going to be the number of interest I'm going to be collecting. Okay. So again, this will definitely benefit you more if you have Excel readily available to you, okay? So once again, we're going to practice that formula once again in the next scenario here, okay? So once again, we know that 90 days is equivalent to 0.25 of a year, right? While 6 months is 0.5 a year, okay? So therefore, let's go ahead and solve for the following scenarios, okay? So my future value, once again, for if I borrowed 15,000, so principal, okay, times parentheses 1 plus parentheses your R of 5.12%, okay, divided by the number of times compounded. So in this case, it's going to be compounded every 4 months. 4 times, so every 3 months, every quarterly. Going to end that parentheses twice. You have your caret, open parentheses, okay? 4 times 5, because it's 5 years, all right? End your parentheses. And what is your future value for the very first example?
$19,344.84.
Good. All right. Which then brings my my interest to be
$4,344.84.
good. Okay. So then let's do the second example here, but make sure that you change the time because, again, it's in terms of years. Okay, so in this case, right, once again, I'm going to do my principal of the 4,521.50, okay, multiply by parentheses 1 plus a parentheses, my rate of 0.0245 divided by the number of times. So in this case, it's compounded twice a year. Okay. Close parentheses, caret, open parentheses, 2 times 0.025. Okay, which is equivalent to 3 months. How much is my future value here? Anybody? What's the future value?
I got $4,549.11.
Good. Which then brings my total interest to be
$27.61.
27.61. Good. Last but not least, let's go ahead and compute this last one here to figure out how much future value is going to be here. So again, principal of your 384,125.22 multiply open parentheses 1 plus open parentheses of your 0.789 divided by 3, which means every 4 months it's going to be compounded, so a third of a year. Close parentheses twice, okay? You're going to have your caret, okay? Open parentheses. 3 times 0.05 because it's half a year, 6 months. Okay? So therefore, what is your total future value here?
Uh, 391,677.45.
Okay, so therefore, what is your total interest here? What's the total amount of interest here?
Uh, 15,252.94.
Okay. So let's take a look at this, okay? If you actually notice this, the only difference between this one is that we just added an extra component, right? So let's compare, right? If I were to use compounded interest versus simple interest, let's go ahead and compare. So the very first one, I borrowed, let's say I borrowed money, right? 15,000, and I used the compounded 4 times, which is every quarter, and I get a total interest of $4,344.84. Where compared to this one, I only got charged $3,840. So in this case, that was a drastic change between the two interests that I've collected. Okay. Whereas if you're simply looking at something small like this 4,521.50, right, where I compounded twice a year for 30 months. For 3 months, right? I've only collected $27.61 of interest. Where if compared to my simple interest, I actually got $27.69. So I got a higher amount of interest here. Okay, depending whether you're having a bank bond or whether you are owing money. Okay, so it could be good or bad. Right. Last one here. Right, I got a total interest of $15,153.74, where compared to being compounded, gave me a total of $15,252.96. So in this case, you was only difference of $100. Okay, so as far as that, it really depends on what the circumstances are. But because we know how to calculate both, you can go ahead and calculate this when you're given the situation, right? And making sure that you go through every single component of what you're signing up for. Right. Last but not least, let's go ahead and do question number 5 here, where what we're going to do is we're going to practice making a payment to our bank loan and et cetera, et cetera. So it says right here, you're going to be journalizing the bank loan that we did in example 3. Okay, the bank loan was made on June 1st of 2020. So, okay, June 1st, right? Let's go ahead and take a look at an example of that question 3 right here, where we actually borrowed a bank bond for $5,500. So in this case, right, first thing we want to do is it's June 1st, okay? And we're going to say, well, when we get a bank loan, right, that means our cash flow is increased because we borrowed money. So therefore, we actually have money now in our checking account. And this, I'm going to put it right here as a bank loan. Okay? And it was for $5,500. Okay? Now, as always, right, when we normally get our first bank bond, interest does not accrue until you have, had it for quite some time. So in this case, we just got the bank bond, so there is no need to have to charge interest just yet. Okay? We just got the bank bond. Okay? So therefore, right, our very beginning of June is that our principal is 5,500, right? No interest rate just yet. But in this case, let's go ahead and figure out what happened. So in this case, again, we normally do not get charged interest, okay? So, but in this case, because the way that I have set it up, I need to calculate for July's amount of interest that I should be collecting. So in this case, right, my total amount of interest rate, which we took a look here, right, my interest rate is going to be 6.25%, okay? In this case, because we're calculating on a month-to-month basis, since it's an annual rate, we do need to figure out what 6.25% divided by 12 is, which in this case gives me a total of 0.52%. So in this case, right, if my interest rate was 0.0625, and we're going to divide that by 12, you would get a 0.05208. You get this long number here. So that means the monthly interest that's going to be charged for the month of July is going to be $28.65. So therefore, my current balance is now going to be my $5,500 plus my interest of $28.65 to give me $55,28.65. So therefore, since that's my principal now, I'm going to go ahead and say, well, if I made a payment of $200 in July, let's go ahead and journalize that real quick. So that means on July 1st, right? If we decide to make a $200 payment and our current outstanding balance right now is $5,528.65. First rule of thumb is that you're always going to be making a payment, obviously, to your principal, to your bank loan, but you're going to always pay the interest first. So in this case, you're going to have what's called interest expense. All right? And of course, always you're going to pay using a checking account. So in this case, I'm making a $200 payment, right? However, I've calculated what the amount of interest I'm collecting for that month, which is $28.65. So therefore, how much money is actually going to be going towards my actual principal? How much money is actually going towards my actual principal?
$171.35.
Exactly. That's how much is actually going towards your principal. Okay? So therefore, right, in this case, my new balance, if I go ahead and take my $5,528.65 and I make my payment of $200, right? Now my new balance is going to be my new principal, which is going to be the $5,328.65, which once again, I'm going to recalculate because now I need to solve for my interest that I'm going to collect as of August. So in this case, right, same thing is going to go here, that your rate is going to be the 0.625 divided by my 12 months to give me an annual, or in this case, a monthly percentage rate of the 0.052, and so on and so forth, right? Okay. But however, now let's go ahead and calculate what the monthly interest I'm going to be collecting here. So what is my new principal of the $5,328.65, right? It's always going to be based on after the payment is made. It's going to be compounded, which means it's going to just accrue interest on top of interest on top of interest, okay? So in this case, right, if I have $5,328.65 and I'm going to multiply it by my 0.005208, what should be the total monthly interest that I'm going to be collecting?
$27.75.
$27.75. So therefore, my current balance is going to reflect that I owe $5,356.40. So in August, if I made a total payment of $250 this time, let's go ahead and journalize that. So on August 1st, I'm going to make the same exact journal entry, except this time my numbers are a little different, right? I'm still making an actual payment to my principal, but I am making a payment to my interest first. And this time, I'm cutting a check out for $250, okay? So here, my calculated interest that I solved for was only $27.75, okay? So therefore, how much money am I actually paying into my actual principal?
$222.25.
Good, $225.25. So therefore, my new account balance, right, is going to be this. Subtract my payment of the $250 to give me a new statement balance of the $5,106.40. So that means that's going to become my new principal. Okay? So on and so forth. So let's figure out what this statement or the interest rate, or in this case, how much interest I'm going to collect for September. So in this case, right, I'm still going to multiply those two numbers together, and I should get $26.60. So notice this. Every time I make a payment, if I pay more than the minimum, I'm going to obviously get a lesser interest collected, right? But here's the rule, and you should always know this. No matter where you at in the beginning or the ending of your bank loan, you will always end up paying the interest first. Okay, so at the end of the day, no matter what it is, you're at a lose-lose situation because you can never get out of interest. Now, of course, you can shorten the time limit of how much interest you could be accrued, but at the end of the day, the interest is already calculated. So there's no way going around it. You pay, you pay, you pay. All right? It's just the longer that you keep it outstanding, the longer and more opportunity that interest can be collectible. Okay? So once again, if I started with my principal of the $51.06 and I add my $26 of interest, okay? And then this time for September, I end up making a payment for $300. So let's go ahead and take a look here on September 1st, right? Same thing's going to happen here. I'm going to make a payment to my actual principal, make a payment to my interest expense, okay? But this time, my amount this time is $300 opposed to the earlier situation, which was only $250. So therefore, the interest that I've calculated was $26.60. So therefore, I should have a total that I'm actually paying to my principal to be a total of $273.40. So once again, I'm going to subtract that amount, okay, to give me a new grand total amount to be for $4,833 even. And once again, that becomes the new principal. Okay, so in this case, I don't need to solve anymore because I don't have an October payment. But as you can see, this is how a real credit card or a real bank loan is actually calculating the interest. And this is how they make a monthly breakdown on your monthly statement every single time. They take with the amount that you owe, they calculated the annual percentage, right, as a monthly percentage, and then they figure out, okay, well, that means your minimum here should have been at least $25, okay, or at least $30 to cover the interest, and then any payment after that is going to cover your actual principal. So in this case, your minimum should be $30 here, okay? So any questions in regards to journalizing a bank loan and how every payment you make is always going to split between the interest and the actual principal?
No.
Okay. So, since that took up a lot of extra time because I end up explaining